Good morning, everybody. It's Tuesday, July 9th, 5:25 a.m. Central Time. Grain markets are mixed this morning. December corn futures down a quarter cent at 407 and a half. November soybeans down 5.5 at 1094 and a quarter. December Chicago wheat up 1 at 595 and a half. December Kansas City wheat up a quarter at 596. December spring wheat up 3/4 of a cent at 636 and a half last trade. Let's start off with this price action, which has been very poor.
Grain prices have fallen to their lowest level since 2020. On Monday, December corn fell 4.3%, while November soybeans lost 3.1%. The decline is due to Hurricane Beryl bringing timely moisture to crops across the Midwest, and the USDA reporting yesterday that corn and soybean crops are in the best condition they have been in 4 years for this time of year. Grain prices have been on a downward trend over the last 2 years as global production has increased. Prices have also fallen due to sluggish U.S. exports.
Bloomberg has this grain sub index, which is trading at its lowest level since 2020. I don't know exactly how they put that together. Here's a monthly corn chart, and this is still using the July contract as spot month, but you're back to pre-COVID price levels. So inflation be damned. Corn is back to levels that we saw before all the money printing and the easy money policies, which is really tough to stomach. The U.S. farmer is going to lose money this year in all likelihood. We're below production costs now by a wide margin. The stuff Mackenzie mentioned is short-term stuff. So you've got this hurricane bringing some rains. Okay, that's a short-term reason. You've got crop ratings improving. Yeah, that's a short-term reason. Big picture, what's the problem? The problem is that farmers are holding too much. That's part of the problem. Corn stocks as of June 1st were 3 billion bushels. So that represents about 20% of last year's 15.3 billion bushel crop. That was a huge crop last year. The expectation is that we've got a big crop coming this year. The demand side is just as problematic. We've got kind of what I would call a stagnant demand base for corn. You've got a few different segments. Feed demand is largely stagnant, doesn't move around a whole lot. Ethanol demand is great, but largely stagnant, doesn't move around a whole lot. Exports are a smaller item on a percentage basis, but they can really move the needle. And exports just haven't really been doing the job, especially when it comes to new crop. New crop corn export sales are not good. New crop soybean export sales, the book there, as I've talked about at length, it's the worst in 20 years. And when it comes to soybeans, USDA projects that exports are going to account for 42% of all demand for soybeans grown in the United States next year. And the export book is like non-existent. So we've got demand problems. I think the market's job right now is to find a price level that stimulates demand. And I don't know that we found it yet. Maybe we found it in wheat. We saw a really good wheat export sales number last week. Maybe that's a one-off. Maybe it's a sign of things to come. But this is just not good.
Fund traders currently hold a record net short position in the corn market. CFTC released weekly commitment of traders data on Monday. During the week ending July 2nd, the funds were net sellers of 51,000 contracts of corn. The net short of 347,000 contracts is the largest on record. Funds were net sellers of 7,000 contracts of soybeans, and they were also net sellers of 5,000 contracts of SRW wheat on the week.
These positions are probably larger in real time. Private groups estimating that the funds were net short 365,000 contracts of corn at yesterday's close, about 140,000 contracts of soybeans, about 80,000 contracts of SRW wheat. Here's the corn managed net chart, premium subs. You guys have the full fund tracker charts in your email this morning. But yeah, 347,000 is a record net short. It barely eclipses the previous record net short, which was from 2019. How long can they stay here? History says not so long, but this time around could be different. I don't know at this point what's going to change their outlook. I think it's got to be, it's very simply, it's got to be either a supply or demand issue. I think for the moment, next couple of weeks, you'd have to see some demand come into the market, and then bigger picture, maybe later in the growing season, you know what, we find out that the flooding up north and the hail over the weekend, maybe it had enough of an impact to reduce acres, reduce yield, that sort of thing. Maybe the wet start to the growing season had an impact, but for right now, these large money managers in net, they just don't see a reason to get out. When you combine corn, soybeans, and SRW wheat, they're almost record net short at 554,000. They were just shy of that previous record from 2019. So yeah, large money managers hate the grain markets.
So if you guys have not checked out our premium content, you sure need to do so. Joe, can you tell me about yesterday's premium video?
Pete joined me yesterday. We talked about the rally in soybean oil, and we tried to start the week on kind of a bright and not so doom and gloom type note. The soybean oil market has acted really well. We had this really strong, like 4-day rally. I believe some big short covering. And we talked about kind of the seasonal, some of the vegetable oil stuff, some of the biofuel demand type stuff. In today's video, I'm going to do kind of a deep dive in regard to the funds, historics, price overlays, that sort of stuff. We've got some mailbag questions from customers regarding the funds and why they do what they do, that sort of thing. If you want to see the premium stuff, go to standardgrain.com. You can sign up this morning. This is a $50 per month subscription. You can cancel at any time. No other fee, no other obligation. Nobody will try to sell you anything else. You'll get our morning email, which goes out every single business day at 5 a.m. Central Time. Tons of information in there. There's a new premium video every day that goes out at midday or about 10 a.m. Central Time. This includes all of my cash grain marketing recommendations broken down by crop year and percentage, a ton of actionable advice here on YouTube and on the podcast. We do the news. In the premium stuff, we do stuff that can actually help your business, whether it's marketing, crop insurance, budgeting, all that sort of stuff. Give that deal a shot this morning, guys. I will forward you a copy of this morning's email.
The U.S. radar is active this morning. Rains related to Hurricane Beryl pushed through parts of Arkansas, Missouri, western Tennessee, western Kentucky, and southern Illinois early this morning. The system is expected to result in widespread rainfall over Missouri, Illinois, and Indiana during the next couple of days. The 6 to 10 and 8 to 14 day maps favor odds of normal to above normal rainfall, but also favor above normal temperatures for the entire U.S. Corn Belt. The marketplace appears disinterested in the heat and appears to be focused on the moisture situation. Only 7% of U.S. corn areas and 9% of U.S. soybean areas were experiencing some degree of drought as of July 2nd.
And some of those areas that are experiencing drought are going to catch rain out of this system. If there was an area that needed rain, we know it's been wet out west in a lot of places, but Illinois, Indiana, and part of Ohio, and I don't know if Ohio is going to catch this or not, but they need the rain, and it looks like it's coming. So short term, most of this that's on my screen here, this big band, this is going to be the next 2 or 3 days, the vast majority of it. This is going to be helpful without a doubt. The heat doesn't scare people, I guess, doesn't scare the market. Remember, these are probability maps. So this bright red just means that there's a strong likelihood of above normal temperatures. It doesn't mean you're going to be 50 degrees above normal. It just means that there's a strong likelihood of above normal temperatures in these areas. So the market's just not concerned about weather. And honestly, we're getting awfully late in the growing season for a crop scare event right now as it relates to weather. Prime time weather season is like, second week in June through about mid-July, and then weather and markets kind of diverge. That's been my experience, at least. It seems like weather and markets are most heavily correlated during that 4 to 6 week period that's going to end here next week or so. I mean, maybe it's different this time, I don't know, but weather's favorable, I guess.
U.S. corn conditions improved slightly last week. The crop was rated 68% good to excellent nationally as of Sunday versus 67% last week. The rating was slightly higher than the trade expectation of 67% and was the best for the week since 2020. Across the Corn Belt, conditions improved in Illinois, Indiana, Iowa, Kentucky, Missouri, Ohio, and Wisconsin. 9% of the corn crop is rated poor to very poor, unchanged from last week. U.S. soybean conditions were also reported at 68% good to excellent nationally as of Sunday, up from 67% the prior week and the best for the week since 2020. Several states across the Corn Belt saw conditions improve, including Illinois, Indiana, Iowa, Kentucky, Michigan, Ohio, and Wisconsin. 8% of the soybean crop is rated poor to very poor, steady with the previous week.
The trade had expected ratings for corn and soybeans to be unchanged, and we got 1 point better. So this is considered to be a bearish item today in the very short term. Corn ratings are good. To see an uptick this time of year is not totally unprecedented, but generally speaking, ratings trend lower as you get closer to harvest. So we're better than average, and a rating of this magnitude this time of year would equal a trend yield or something close to it in a lot of years. That's not a guarantee. I understand that the crop rating system is flawed. It's a view from the road. I think in wet years like this year, it could be especially flawed. That's just my personal thought. But this is something that does not help price action. What about wheat?
The U.S. winter wheat harvest is ahead of schedule. The crop was 63% harvested nationally through Sunday versus 54% the prior week and 52% on average. The crop is 92% harvested down in Kansas and Texas, and harvest is complete in Oklahoma. The U.S. spring wheat crop was rated 75% good to excellent nationally compared to 72% last week. Declines were noted in Idaho, South Dakota, and Washington. Improvements were noted in Minnesota, Montana, and North Dakota.
The trade had also expected spring wheat ratings to be unchanged, and they rose by 3 percentage points. So that crop appears to be in pretty darn good shape, according to the government.
The harvest of Brazil's second corn crop is progressing at a rapid pace. According to well-followed private group Ag Rural, 63% of the crop was harvested as of last Thursday, up from 49% the prior week. Hot and dry conditions have helped the harvest progress quickly. Last year, during the same week, only 26% of the crop was harvested. CONAB, Brazil's version of the USDA, is projecting the safrinha crop to reach 88.1 million metric tons.
Brazilian farmers, like U.S. farmers, as it would appear, are undersold. I think one of the groups reported that farmers in Brazil have sold 36% of their corn crop. They have some way of tracking it there where we don't really track it here in the United States. That's a number that's historically low. So you got farmers in both hemispheres sitting on a lot of unpriced corn bushels the way that it seems, and that is not a friendly item.
U.S. corn shipments increased last week. USDA reported that 40 million bushels of corn was inspected for export during the week ending July 4th. The print was up 23% from the previous week and up a whopping 173% compared to the same week last year. Soybean shipments declined versus the prior week at 10 million bushels. The print was down 15% compared to the prior week and down 9.2% versus the same week last year. Wheat shipments increased compared to the previous week at 13 million bushels. The print was up 1.7% from the previous week, but down 19% versus the same week last year.
That's a good corn number. Nothing to write home about in soybeans. It's an okay wheat number. We're going to hit our targets for row crops this year. I think, as I mentioned earlier, I think the market is starting to look at the new crop situation, and the book of sales there for corn and soybeans are just not where they need to be or should be, especially considering how low the prices are. It's early, and export business could come in very quickly if the price is right. But for now, the price is wrong. So, I mean, that's the way it looks. I don't know. You think we'd be cheap enough?
We did have a flash sale of corn on Monday. U.S. exporters sold 5 million bushels of corn to unknown destinations. Of the total, 2 million bushels are for delivery during the current marketing year, and 3 million bushels are for delivery during the next marketing year.
Yeah, I mean, so it's a sale, but it's small. Only 84,000 for new crop. I mean, it's just not enough to get anybody excited. What did cattle do yesterday?
They sank lower. Feeders were down an average of $2.01. Live cattle were down an average of $1.34. Box beef was mostly unchanged on Monday. Choice ended the day at $330.47. That was up 4 cents, and select ended the day at $304.72. That was down 34 cents.
Outside markets, U.S. dollars flat. Stocks are up again. The S&P is up 13 points. Posted fresh all-time highs again yesterday, and I believe again overnight. Bonds are off a little bit. Crude oil is down 42 cents in the August WTI at 81.91. Have a great day, guys. We'll talk to you Wednesday.